I want to wish everybody good morning or good afternoon, depending on where you're at in the country. We want to welcome everyone to today's presentation covering the EquiTrust's DynaMARC Indexed Annuity Solution. Our presenter today is Jason Goodrich with EquiTrust's Life, and I want to remind everybody we don't open the phone lines up, so please use the dialog box and just ask your questions that way. We'll try to get those fed over to Jason. I'd also remind you that if you've got any questions or you'd like an illustration on the DynaMARC, you can reach out to your Great Plains annuity marketing specialist. They'd be happy to run you an illustration and walk you through all the finer points of the product. If whatever Jason does today, we can reinforce that for you. EquiTrust is one of our flagship carriers, one of the top companies at Great Plains. They've been on board with Rich and the company since its inception about 13 years ago. So we really have a solid relationship there. We really appreciate working with EquiTrust and Jason helping us out today. Jason, I know DynaMARC's rapidly growing and your overall sales percentage there at the home office, so let's get started. Take it away.
Great, appreciate it, Rob. Good afternoon, everyone. Thanks for taking some time out of your busy schedules this afternoon, I guess now, to join me today to talk about the newest annuity from EquiTrust Life Insurance Company. The DynaMARC Indexed Annuity was released about 10 months ago, and I can tell you the feedback and the sales on the product have been extremely strong. It's already risen to one of the top few products within the EquiTrust annuity portfolio. As we go through the presentation today, I'm going to touch on some of the reasons why I believe the product has already been so successful. I'm going to touch on the base product, go into a little bit of detail on the very competitive income rider, which is new on this product. And we're also going to spend quite a bit of time talking about what I believe is probably the best feature on the product, which is the exclusive indice that is available only on the DynaMARC Index Annuity. This indice is called the Dynamo Strategy and was designed and developed exclusively for EquiTrust Life Insurance by Goldman Sachs. However, I'm going to try and keep things at a pretty high level so as to not take up too much time from your busy schedules today. I'll probably keep the presentation around 20 minutes or so, but as Rob said, feel free to type in any questions you may have, and then at the end of the presentation, I'll come back and try to answer any questions there are. Lastly, I just want to take a minute and thank Rob, Rich, and all the great folks over at Great Plains Life and Annuity for their longtime support of EquiTrust Life. They were actually one of the first group of 4 or 5 IMOs to appoint with EquiTrust almost 13 years ago. So they've been with us since the very beginning. EquiTrust will be 13 years old in November, and Great Plains has been with us since the very beginning. They're just a tremendous IMO to work with and really appreciate the relationship with them. With that, let's go ahead here and get started. Okay, the DynaMARC Index Annuity, this actually is the first product in a new series of products that EquiTrust will be rolling out over the coming months and years, what we're calling the Strategic Series. Most of you on here, I'm sure, are familiar with the EquiTrust Market Series of products, what we call the Simple Series, the Market Power, Market 12, Market 10. All those products are actually part of the Simple Series, and there's no changes planned for those or anything. We'll continue to be our main lineup of products. But with the DynaMARC, we started the new Strategic Series, and we'll be adding future products to this actually in the coming months and years. Now, kind of the key feature with the DynaMARC, as I mentioned a little bit ago, is the Goldman Sachs Dynamo Strategy. This is an exclusive strategy to EquiTrust, and it was designed, developed, and implemented by Goldman Sachs. I'm sure most of you have dealt with volatility type control indices, so I thought I would mention kind of how we position the indice and how we market it. Really, when this was developed, the main goal for Goldman Sachs was to try to achieve a greater stability of returns for your client. Okay, so instead of having returns that are kind of bouncing all over the place, like you might see with the S&P 500, we really wanted to get consistent returns so they could get more years of actually compounding interest on the product. We kind of use the baseball analogy when describing the Dynamo Strategy. So the client may see less home runs, but they're also going to see less strikeouts. Okay, so a lot more consistency in returns, a lot more singles and doubles, which over the long term, we feel will benefit the client more. Okay, before I get in and talk a little bit about the indice more and kind of how it works, Let me just kind of walk through the base, the base features of the DynaMARC annuity. First off, it's just a 10-year surrender schedule starting at 10%. It is flexible premium. The initial premium is $10,000. We issue all the way to age 80. It does have 10% free withdrawals after the first year. It does have a nursing home waiver after 90 consecutive days in a nursing home. And our street level commission is 7%. As you may know, we do not reduce commission on our index annuities, so the 7% commission is paid all the way up to age 80. Then lastly, there is an income rider on this, which I'll talk about in a second. So with this product, it's very much an accumulation type product, so there's no bonus on it or anything like that. It's really designed for maximum accumulation, which I'll show you an example in a little bit here. So that's the base product. Then within that, there is an income rider. Now, this income rider is different than the income rider we have on the market series of products. So the only product this income rider is available on is the DynaMARC product. And now it is a stackable design, okay? First off, there is a 10% bonus on the income rider. As I mentioned a little bit ago, there is no bonus on the product, but there is a bonus on the income value. So if they put $100,000 in it, their account value at the beginning will be $100,000, but their income value will start out at $110,000. And that bonus applies to any premium in the first year on the income side. As I said, it is a stackable design, and the way it works is they get credited 4% plus whatever the percentage of growth is in the index. Okay, so if the index, let's say, goes up 3%, we would credit 4 plus 3, or it would roll up at 7% for that year. And it is an annually compounded rate. Okay, if the market goes down and they get credited 0, it would go up at 4%. So at a minimum, it's going to go up 4% at an annually compounded rate, but then plus the interest earned. Now, the minimum age to begin it is 50. We do allow you to add the income rider at any age, similar to our other income rider. So there is no minimum age requirement as far as adding it. The fee is 95 basis points, so a little bit higher than our other one. But once again, it is based off the accumulation value, not the income value like a lot of the other ones out there. So it's just 95 basis points off the accumulation value, and that is locked in. Lastly, the withdrawals are available after the first year. With our other riders after the second year, and this one is after the first year. And this is an optional rider, okay? So they do not need to add this. With the DynaMARC product, only about 35% of the people actually add the income rider. So it is lower than what we see on our other series of products as far as the income rider. It really is, as I mentioned, designed for accumulation. Here's the payout factors on the income rider, just so you have those. They are the same as they are on our other products. One thing that's different is the income withdrawal percentages increased by 10 basis points for each age between the ages shown. Okay, so for a 65-year-old, if they turn on the income, it's 4.75. If they wait till they're 66, it would be 4.85, and 4.95 if they're 67, and so on. Okay, let's talk a little bit about the Dynamo strategy. Now, when Goldman Sachs developed this strategy, they really had two main principles in mind that they thought would help maximize the return. The first theory is the modern portfolio theory, and basically all that means is diversification. Okay, so they really wanted to diversify this strategy. So I'll show you in a minute, but within the Dynamo strategy, there are 5 asset classes comprising of 8 components. And it's going to include both U.S. and international components. So it is very diversified. And what Goldman Sachs believes is with the diversification, it's going to improve the potential for returns in varying economic conditions. A good example of how diversification worked is during the Brexit situation that happened a few weeks ago. Obviously, the S&P went down quite a bit during that time. The Dynamo strategy actually went up because they weren't all in equities. It was in other things as well, and it actually still performed through that downturn in the markets. And I'll talk more about that in a second too. So that's the first theory, diversification or modern portfolio theory. The second principle is what's called momentum-based investing. And I'll show you an example of this in a second too. But really the goal of momentum-based investing is to take advantage of the momentum in the market and rebalance each month based off the momentum within the market. Okay, so they're moving money out of underperformers and rebalancing them into the into the overperformers, basically. Okay, with momentum-based investing, what they do is we'll go back each month and look at the previous 6 months' performance, and whichever combination of components performed the best over the previous 6 months, that's where they rebalance to at the beginning of each month. So it's finding the momentum within the markets, rebalancing there to get the best, to maximize the returns. And I'll show you another example of that in a second here too. Okay, let's talk a little bit about the process. I talked a second ago about diversification and the 5 asset classes and 8 components. And on your screen now you see those. So the asset classes are equities, bonds, commodities, real estate, and cash. And as you can see within those, we have US and European components. So lots of different possibilities there. Also, different than some of the other ones out there, we put a maximum weighting on each asset class, which obviously is going to help it keep it more diversified. So we can't put 100%, for instance, in bonds. You know, there's a maximum weighting on everything, so that actually we are forced to diversify it. Okay. The other thing is we don't require to use the fixed account like some of the other ones out there. So I'll talk about it in a second, but there is a fixed account on this product, but you don't have to use it. You can mix and match it how you like. Okay, the second part of the process, which I just talked about a little bit with the momentum-based investing, is the dynamic rebalancing. As I said, we do this on the 1st of every month, okay? So every month it's going to rebalance. And like I talk about, what it's going to do is look at every possible combination of those different asset classes and components we talked about. Okay, so the hundreds, thousands of different combinations. It's going to look at how every combination would have performed over the last 6 months based on a 5% volatility cap. Okay, whichever one of those returned the highest return for the client, that's where it rebalances for the next month. And the following month, it just goes through the same thing again. Okay, that is the momentum-based investing. And that's how the rebalancing works. Here's kind of a chart with a lot of colors, and it's kind of busy, but I think it shows really kind of how the momentum-based investing works. If you look at the chart in front of you, and for example, if you go back and look in January of 2008, 2009 in that area, you'll notice that there's no the light green disappears. There's no equities. You also notice there's no real estate. Why? Because as you guys know, equities and real estate were not performing well then, so it moves all the money out of that. And during that time, a lot of it was in bonds, and bonds have actually performed very well for a long period of time. Same thing if you look at 2016 right now. At the end there, you can see that there's no money actually in equities. We had a lot in bonds and some in real estate, and that's why during the Brexit situation, it actually performed very well, because although equities were down, bonds were performing well. So people were getting good returns during that. Okay, we have there's a website called Solactive.com. That's just www.solactive.com. On the bottom of your screen there, where it says source, you can see the website there. It's a great place to go if you want to see how it has rebalanced every month since inception. And you see a chart like that, and there's just tons of good information in there. So if you go to Solactive.com and you just type in Dynamo in the search field, it'll bring up a great piece for you. Right now, how it's balanced as of July 1st is there's money in bonds, real estate, and commodities. Okay, that's where the money is currently at for the month of July. Okay, so it's very transparent. You can, like I said, you can go to the Selective website. You can see everything and anything you want to know about the Dynamo strategy. It's completely transparent. It's all rules-based. So there's not somebody deciding where the money goes. It's 100% rules-based. Okay, then the last part of the process of the rebalancing is the volatility control. As I mentioned, we have a 5% volatility target on it. So when it does rebalance, it's going to go to the highest performers up to a 5% volatility. Okay, then daily it will go in and look at it and make sure the volatility doesn't exceed 5.5%. If it ever does, in one day it's above 5.5%, it'll move a little bit of the money into cash to lower the volatility to 5.5% on that day. Okay, what this really does is, as we talked about, it's going to reduce the upward and downward swing. So less home runs, less strikeouts, a lot more consistency of returns and consistency of compounding. Okay, here's where the different strategies are on the product and what the caps are and rates currently are. You can see the first two listed there are the Dynamo strategy. Now, we chose, different than many of the volatility control indices out there, we chose to go with a participation account. As you probably know, a lot of them have spread accounts. It's our feeling that with the design of these indices, which really is, more moderate, consistent returns, that a client's going to get a better outcome and better crediting from a participation strategy. A good example is if, let's say, you have a 3% spread. If you get a 6% return and you have a 3% spread, well, the client's going to get 3%. But if you have a 6% return and a 75% participation rate, well, the client's going to get 4.5%. And with a strategy like this, we expect a lot more than 4 to 6% returns. So we think a participation strategy actually is the best performer for the Dynamo strategy. Now you can see with the Dynamo index, there's two potential strategies: the 1-year point-to-point, which has a 75% participation rate, there's no cap, no spread, and the 2-year point-to-point participation account, which is a 100% participation rate. And that's where the majority, I'd say, of the money is going right now, is the 2-year point-to-point participation index account. Okay, but in addition to the Dynamo, we also have very competitive S&P strategies on it. So we have an S&P 1-year point-to-point with a 4.25 cap. It has a 1.8 monthly cap. Fixed accounts 225. So they, as I mentioned earlier, they can mix and match however they want between there. So they can put 25% in each of the different index strategies, which might not be a bad idea, to diversify within the product. So very competitive, as I mentioned, as an accumulation type product. And the other thing I want to mention is part of our agreement with Goldman Sachs is that we have fixed option costs on the Dynamo strategy. Okay, what that means is once the policy is issued, they can't change the option cost of the Dynamo for that client. So really, as a client, they shouldn't see a change in that participation account for the life of the product. So if they chose the 100% 2-year point-to-point participation, it should stay at 100% at renewals. It's not guaranteed. I do want to point that out, but that's where it should stay. Now over on the right-hand side, you see the illustrated rate. So that just basically shows you, if you run an illustration on this product, what it's going to illustrate at based on the strategies you select. Also, keep in mind with the income rider, if you add the income rider, they get 4% plus growth. Okay, so for instance, if you ran the income rider and you use the 2-year point-to-point, the participation, or excuse me, the 2-year point-to-point participation account, the income rider would illustrate a 7.7% annual compounded rate. Okay, because the annualized return based off the last 10 years on that is 3.7% a year. So 3.7 plus 4 is 7.7. Okay, if you did the 1-year point-to-point on the S&P, it would be 6.33 would be what the income rider would roll up at on the illustration, annualized. That's the current caps and rates. Whoops. Okay, here's a sample. I just mentioned the income rider. Here's a sample page from the illustration showing the income rider. This is the guaranteed page. So you can see the highlighted area there is showing what the income would be in year 11 if a 55-year-old put in $100,000. Okay, now this is the guaranteed page. So this assumes in those 10 years there's 0 growth every year. So this is just a 4% roll up. Obviously that's not going to happen. If it does, we're going to have bigger problems. But you can see the income payout would be $77.34, worst case scenario for that client. Now this is the non-guaranteed page of it. Okay, and if you look there, you can see if you go over about 5 or 6 columns there, you'll see where it says roll up percentage. So that's using the last 10 years showing what it would roll up at. Okay, so it's 4% plus growth. So you can see it rolled up to 7.22. Year 2 is 11.41, 5.49, 5.84. For those 10 years. So the income payment on that scenario is going to be $10,619. Okay, obviously it's not going to roll up like that every year. This just gives you an idea that the guaranteed on it's going to be $7,700, the non-guaranteed $10,619. Just to give you an example, if you look at like our Market 12 product, which has our best, highest guaranteed income roll up, which is also a very competitively in the industry, that comes out at about $9,500. Okay, so by choosing an index or an income rider like this, on the guaranteed side, you're giving up about $1,900, but you're getting the potential of an additional, $1,500 or so on that. So it really depends on the client. Obviously, a lot of clients are going to want to know exactly what that amount's going to be, and some may want to go for a little higher amount. Okay, so when you look at this strategy and you look at the client advantages, obviously the big one is the potential for the highest risk-adjusted returns. Really to smooth out all the ups and downs in the market and get more steady compounding, even though the returns may be more modest. As I said, Goldman Sachs has told me they expect on average more of a 4 to 6% return range. You'll still have some 0 years, but you should have less than you would like in the S&P 500. And then the income rider on it's been very attractive too because of the 10% bonus and the potential roll-up. As guaranteed roll-ups get lower, these stackable designs are getting a lot more attractive because there's potential to get a lot more income down the road. Last thing I just want to mention is there's a lot of different material on our website that you can get on this. You can illustrate it, obviously. Down towards the middle of the screen there, it shows the Selective website again, which I encourage you to go to. It's a client piece too, so it gives tons of information about the Dynamo strategy historically and how it works and how it rebalances. So just a great piece. And then the last thing is required training. If you did training with us a long time ago before the DynaMARC came out and haven't done it since, you'll have to go back in and do the DynaMARC training before you can solicit business. So, give us a call or give Great Plains a call to make sure you're up to date on your training before soliciting anything within the product. Of course, our disclosure there on the DynaMARC. And with that is all I have today. I will pass this back over to Rob, excuse me. You can see all the Great Plains contact information there and encourage you to give them a call if you have some questions or want any material sent out or an illustration ran or anything like that. So do appreciate your time today, and I'll pass it back off to Rob.
Hey, Jason, thanks so much. I want to mention that EquiTrust is one of our primary sponsors for our upcoming Legends of the Plains Golf Incentive. We're going to hold that here in Kansas City at the end of September. I see several of you that have already qualified that on today's webinar. Also wanted to let you know I spoke to Rich this morning. For the months of July and August, we're going to do double credits on your EquiTrust business to help get some more qualifiers and fill out some foursomes here. So please be aware that if you're working towards that incentive goal, EquiTrust production will sure help you get there in July and August with double credits. Want to encourage everybody to join us next Tuesday when we'll have Matt Stiles from EquiTrust covering their phenomenal single premium life products. A tremendous opportunity for today's agents to help clients that have assets sitting in places where those are earmarked for heirs, for grandkids, kids that are just sitting in accounts where that death benefit could make a very efficient wealth transfer opportunity for you. And EquiTrust is the leader of the pack as far as the SBL product portfolio they've got. Jason, thanks again. We appreciate you helping us today. Hang on just a second, Jason. There's got one question here.
Okay.
If I can get the... Okay, why do you illustrate the rates so low? I guess.
Well, I mean, the illustration is based off the last 10 years' performance. So we're just taking, when we run an illustration, we're just running it based off how would it perform over the last 10 years, which is how we're required to do it. There's regulation about how you run illustrations to come up with illustrated rates, and that's what it is. When you look at the illustration, it will actually show the best 10, the worst 10, and the last 10. And actually, the last 10 are the worst 10. They're the same. So we're actually looking at the worst 10. The numbers I showed you were actually the worst 10 years, too.
Okay. Well, very good. I want to thank everybody for joining us. Again, don't forget next Tuesday in our EquiTrust Single Premium Life webinar. And everybody have a great day. Thanks so much. We'll see you next time.